Welcome to Quick Chats. I'm Katie Lyles with Lane Gorman Trubit, Accountants and Advisors. Our Quick Chat is now a series on YouTube, so make sure to like and subscribe below. Everything discussed in today's video will be available in the description box. Please comment any questions you may have in the comments below, and we will answer them in a future Quick Chat. If you need more in-depth information, you should email us at askus@lgt-cpa.com to set up a free consultation. Today, I'm chatting with LaChance, a partner at LGT and a leader in our not-for-profit niche. He's a certified public accountant and a certified internal auditor. Lucas is a prolific public speaker and educator, and he's presented on accounting and not-for-profit related topics, both nationally and locally. In 2020, Lucas spoke on revenue recognition within the not-for-profit niche. And today we are going to discuss with him some of his frequently asked questions from his presentation. Thank you for joining us today, Lucas.
Thanks, Katie. I'm glad to be here.
Now, before we dive into the FAQ, can you tell us a little bit about the presentation?
Sure. My presentation focused on revenue recognition of all types for not-for-profit organizations. So that means that I focused on exchange type revenue as well as contribution type revenue and the new standards that govern both of those topics.
Okay, well, let's dive right in. The first question is, are the ASU 2014-09 and the ASU 2018-08 for all entities or just for not-for-profits?
It's a good question, and you'd think that both of those would apply specifically only to not-for-profits, but actually ASU 2014-09, which is revenue from contracts with customers, and 2018-08, which is contributions made and received, both apply to for-profit entities as well as not-for-profit organizations.
And earlier this year, FASB issued ASU 2020-05 that delayed implementation of revenue recognition standard in certain circumstances. Does ASU 2020-05 also delay the effective date of ASU 2018-08?
It does not, actually. 2020-05 specifically extended the implementation period for revenue recognition under 2014-09, which is revenue from contracts with customers in certain circumstances. But unfortunately, it was silent on implementing 2018-08.
And the ASU uses the phrase certain not-for-profits. Can you clarify what makes a not-for-profit qualify?
Sure. Well, in the presentation, I didn't specifically line out what the definition is for certain not-for-profits. From the ASU directly, it means a not-for-profit that has issued or is a conduit bond obligor for securities that are traded, listed, or quoted on an exchange or over-the-counter market, which is just a fancy way of saying that the not-for-profit has securities that are traded or exchanged on the public market. There are certain not-for-profits that do qualify for this, but they're not very common, and so that's why they're carved out just under certain not-for-profits.
The next few questions are about general information for not-for-profits. Let's start with, if money is given to a not-for-profit for a particular project with the intent that any unused funds will be returned, seems like it should not be recognized as revenue until used. When is the correct time to recognize revenue of this type?
Under ASU 2018-08, you'd have to evaluate whether or not the funds are conditional, meaning that there was a barrier to recognition that they needed to overcome, and that the unused funds would have to be returned, or the donor would be released from the obligation if you don't meet a certain threshold. If the funds meet both of these conditions, then the auditors would be correct in saying that you shouldn't recognize the funds until the conditions surrounding them are substantially met. If you determine that a barrier and a right to return both do not exist, then funds should be recognized as revenue and evaluated to see if there are any donor restrictions. In this case, it seems like the donor has given you funds for a specific purpose, so the funds would be recognized as revenue, but with donor restrictions.
In your presentation, you talked about coming to an agreement with an audit client about the application of these new accounting ASUs. Can you clarify what auditors can do when clients seek advice on individual transactions so you don't end up potentially violating your independence?
Sure. That's an excellent point about clarifying language in my presentation. When clients have questions about the applicability and implementation of a new standard, management must make all of the decisions. Practitioners in public practice can provide resources and inform clients about best practices, but practitioners must not make any decisions that, whether in fact or appearance, are reserved for management. Doing so impairs the practitioner's independence.
If an animal welfare organization similar to ASPCA solicits donations based on the medical condition of a particular animal, donations come through Facebook, social media, with no explicit right of return. While the organization should use the money for medical expenses, it is not officially restricted donation, correct? Do public contributions fall under different rules?
Well, when there's a question about whether or not funds are restricted, as an auditor, I always look at the communication with the donor. We review the solicitation letter, or in this particular instance, maybe it's the social media posting, any written communication between the organization and the donor, any internal memoranda that documents oral discussions, and finally, the thank you letter to the donor. Given the fact pattern here that funds were solicited for the treatment of a specific animal or for a specific type of illness, to me, that would indicate that the funds are restricted by the donor. A good way to navigate through this would be, though, to have verbiage on the social media post that indicates that if the funds received through donations are more than sufficient to treat this specific animal, excess funds will be used to support the overall mission of the organization. That essentially turns the unused funds into unrestricted funds once the initial obligation for that specific animal is met.
Our next question is about performance obligation. Does the resource provider have to be the beneficiary or the recipient of the performance obligation, or can the community be?
That's a good question. Actually, the resource provider, meaning the donor or the organization that provides the funds, does not have to be the recipient of that performance obligation. So consider an example where a private foundation may give a not-for-profit a grant that's contingent on serving 8,000 veterans annually. In that instance, the performance obligation did not benefit the foundation at all, but it still is a hurdle that the not-for-profit has to overcome in order to recognize the grant funds as revenue.
In your presentation, you talked about several different case studies on revenue recognition, and I have a question about one of those. This question is about the case study where a student received a grant to assist with tuition. What happens if the student withdraws prior to incurring the tuition fee? What is the right of return for the grant money allocated to the tuition payment?
Well, you're correct that the fact pattern did not explicitly state a right of return in the presentation. So for an answer to this, we would look at the scholarship award letter to see if there are any stipulations. Assuming that everything was silent on this topic, ultimately the school could apply the funds to whatever the student's balance was and either take the remaining amount to unrestricted funds or utilize the remaining portion in a general fund for scholarships to remain true to the intent of the donor.
And you also talked about not-for-profit fundraising galas, and in regards to ticket and transactions that have elements of both exchange and contribution. Does the not-for-profit have to record them separately?
Well, here's where materiality comes into play. If the amounts are immaterial to the financials, then it may not make sense to go through the additional work of bifurcating the funds. Also, immaterial amounts would not sway the reader of the financial statements one way or another about the not-for-profit's health. However, if it's material, maybe one large fundraising gala for the year that brings in a lot of money, then yes, the appropriate approach is to record the exchange portion as deferred revenue and the contribution portion of the transaction as net assets with donor restrictions.
And is there a central place for the updated footnote disclosures for these standards?
Well, that would certainly make it much easier, but unfortunately, no. There's not really a central place where you can find all these disclosures. I did a little bit of research myself and found one that specifically addresses the adoption of ASU 2018-08. It's in the footnotes for the financial statements of the American Heart Association, and the footnote specifically begins on page 13 of 32.
Our last question is, Can you suggest further reading or research outside of the specific ASUs that a not-for-profit can use for revenue recognition guidance?
Mhm. Well, the AICPA's not-for-profit section has a number of resources. Some of the information is free, while other parts are gated for membership. Of course, you can always sign up for LGT's free community webinars and newsletter with not-for-profit specific content.
Thank you so much for joining me today, Lucas. This is great information for a not-for-profit guest.
Thanks, Katie. It's been a pleasure. I really appreciate time this afternoon.
I hope you enjoyed today's quick chat on revenue recognition in the not-for-profit industry. Please follow us on LinkedIn, like this video, and subscribe to our YouTube channel for more educational videos throughout 2021. See you next time.